Fixed assets accounting, this is our topic, and in this module we will be discussing definition and basic concepts about accounting for fixed assets and depreciation as well. So when we say fixed asset, it is in fact a tangible fixed asset, which is property, plant and equipment. So property, plant and equipment, these are the assets which are used for a time period, a considerable time period, which is more than a year. These are not held for resale. Rather, these are kept for long-term period. And mainly the reason to keep or to hold these type of assets include production of goods or services, selling of goods or services, administrative purpose, and rental to others. So you see that plant and machinery or delivery vehicles or the administrative building or factory workshops or outlets where we put finished product to sell, these are the examples of the fixed assets that we hold for production of goods or services, or that we hold for selling of goods or services. And then for administrative purpose, the building or the furniture or the computer equipments, these we hold for administrative purposes. And for rental to others, these are few examples. You can include rent a car or construction machinery on rental. So these are the examples for the fixed assets which are held for rental to others. Recognize this in our balance sheet as an asset. So the criteria number one is that its cost can be measured reliably. Okay, we can reliably measure its cost through the invoices or through the supporting documents. And number two, there's a probability of inflow of economic benefits associated to these assets. If you don't have probability that there will be inflow of economic benefits to the entity based on these very assets, then these are not the fixed assets. Okay, so future probability of inflow of economic benefits and its cost can be measured reliably. These are the two criteria to recognize these as asset in the balance sheet. Then measurement at recognition. When we say measurement at recognition, we should bifurcate the assets between the assets that we have purchased, constructed or manufactured, and the assets that we have exchanged. Okay, so when we are saying the assets we have purchased or constructed or manufactured, these assets are measured at cost at the time of recognition. Okay, and when we are exchanging an asset against another asset, okay, like you want to buy an air conditioner by exchanging your computers. So you are getting air conditioners by giving computers. So this is known as exchange transaction. So if you are exchanging your asset, then the asset that you are getting in your business will be measured at fair value unless the exchange transaction lacks commercial substance. Commercial substance will be explained little later, but as of now, commercial substance means that commercially or financially the organization will be affected positively or negatively. So if there is a commercial substance over there, then you will measure it at fair value, and preferably fair value of the asset what you are giving. And if the fair value of the asset what you are giving is not known to you, then fair value of the asset that you are getting. Okay. But if there is a lack of commercial substance, means commercial substance is not existing, then the carrying amount of the asset that you are giving will be the cost that you will recognize for the asset that you are getting. Well, this is measurement at recognition. So measurement after recognition means subsequently for the next reporting period. Once you have recognized, and after recognizing, when you are reporting, even then you can change its measurement. So after recognition, the measurement would either be based on the cost model or would be based on the revaluation model. Cost model is simple, that cost minus accumulated depreciation minus the accumulated impairment losses. All these things we will discuss in detail in upcoming modules. Revaluation model, by the way, it is not a part of our syllabus, but revaluation means that you have to remeasure your asset, or in a way you have to put your asset equal to the fair value of that asset. So any decrease or increase in the value by comparing it with the cost of that asset will be accounted for accordingly. So revaluation model or cost model, either of these two will be used if we have to measure the asset subsequent to its initial measurement. Cost concept. What components are included in the cost of the fixed asset? So purchase price less the discounts or rebates. This is the first component. Then we add import duties in this. Then non-refundable taxes that we pay at the time of purchase of the asset, and directly attributable cost. This directly attributable cost includes any cost that is incurred to bring the asset into its working condition. So whatsoever the cost that you will incur to bring the asset into its working condition, for example, you have purchased an air conditioner and you have not installed that air conditioner properly. What does it mean? That this air conditioner will not give you its economic benefits unless it is installed. So the installation cost is the directly attributable cost that you have to include in the cost of the fixed asset. Okay? And then very interesting thing, that estimation of the cost that you will incur when you will be asked to remove this asset from that position. This is known as dismantling or removal cost or site restoration cost. Its estimation is done at the time of recognition, and then it becomes part of the cost of asset. One thing which is not like at your level, it's not a part of your syllabus, but keep this thing in your mind, that this cost is estimated at its present value. So we estimate its future cash flows and then we work out its present value, and that present value becomes part of the cost of this fixed asset. Then depreciation and depreciable amount. Depreciation is a systematic allocation of the cost of the asset over its useful life. Okay? And depreciable amount is in fact the cost of the asset or other amount substituted for the cost less its residual value. Okay? Depreciable. The amount that we will depreciate over its useful life. So for your level, cost minus its residual value or scrap value is the depreciable amount. In detail, we will do its practice, inshallah. And the useful life. Useful life, normally, it is the number of years upon which we divide the life of the asset. this can also be the number of production unit that we are expecting to be obtained from the asset, or the hours at which we will be putting that asset for its usage. And in fact, the depreciation rate is determined based on the useful life and residual value of the asset. So these were the few important definition and the concepts relating to the accounting for fixed assets. Thank you.